Welcome back, everyone. Futures are in the green this morning, cutting some losses from earlier this week after the S&P 500 came close to falling into a bear market. We still just about 10 minutes outside of the start of trading. Meanwhile, Treasury yields are inching higher this morning as investors tentatively look to put their money back into stocks. But our next guest says that the bond market is back and here to stay. Joining us now is Kristen, head of North American investments at Citi Global Wealth. Why, Kristen, is the bond market back and here to stay?
So I think one of the most interesting things that has happened year to date, there's been a lot of focus on the equity market and the declines that we've seen. But something that has never before happened in history is seeing both equities and fixed income decline in the same period by more than 10%. That's what's happened over the past 6 months. This is an extremely rare event. In fact, it's only happened 5 times in history where both equities and fixed income in tandem have declined by even more than 4%. And so what's happened on the back of those other 5 situations? Well, in 5 out of 5, in the 6 months following, fixed income increased in value. So we actually saw an appreciation in fixed income. And in 3 out of 5, equities appreciated. So we feel really good given the kind of historic anomaly that we're in and that significant sell-off, that now's a good time where we may have not hit peak rates quite yet, but we anticipate that it will happen in this year. So adding quality fixed income makes a lot of sense at this point.
Kristen, talk to me about how the Fed plays into this, because you would just sort of think with the Fed raising rates that Treasury yields would continue to go higher and fixed income yields would continue to go higher broadly, right?
Of course. And so this is something about what has the market already priced in versus what is the Fed's trajectory. And so once we saw that 10-year cross over 3% about 2 weeks ago, and we saw real rates turn positive in terms of anticipated inflation out 10 years, that was the area where we really felt that markets had started pricing in a very hawkish Fed. Now, here's the thing is, could there be some continued, have we reached those peak rates yet? Maybe not. But over the next couple of months, as we see, hopefully, inflationary pressures ease, as we see some of the cracks that we're starting to see in terms of the health of the consumer, there is some potential for the Fed to actually put on the brakes. And that's why when you're looking at what are my choices here, do I stay in cash and have that known outcome against inflation of having a negative return versus being able to combat that with some positive returns around high 2s, low 3s when we're looking at high quality fixed income, we're comfortable.
Perhaps for my own edification, historically, what type of kind of flight towards bonds have we seen in times where there are an equity market downturn like what we're experiencing right now?
You're going to see what you've seen over the past week, actually. And so I mentioned that correlation of equities and fixed income wasn't really working in your favor year to date. If I could say there's one healthy thing going on in markets over the course of this week and kind of the past couple of days, it's regained that inverse relationship. And where we've seen it, in the highest quality. So you're really seeing that in treasuries. So that's where you're going to see that flight to quality. It's another argument for why the dollar may remain strong and at these levels. But we're expanding it a little bit further. So we're comfortable with investment grade. The other area that looks really interesting, and I know it's boring, but in bear markets, boring oftentimes is best, is municipals. So another relationship that's emerged is when we look at the municipal bond market, the yields on municipals have reached 90% of taxable equivalents. That shouldn't be the case based on the tax benefits of investing in munis. So that's another area, given the credit quality and given some of the movement that we've seen in underlying rates, where we're comfortable adding exposure.
Kristen, the downside of all of this is that if fixed income is going to do better, stocks are going to continue to do worse, right? What kind of underperformance are you looking? I mean, how long do you think the downturn is? Are we going into a bear market, and then how long is it going to last?
So here's the thing, is that this is not a question of not having equity exposure. So another way to say this, it's not that you should be all in bonds. We're saying bonds are back simply because they have been so out of favor for the past couple of years, and with good reason. If we go 3 years ago, 40% of the world's government debt was negative yielding. Now that's down around 10%. We've been significantly overweight equities over the past couple of years, given the market dynamics, given the economy. So we're still balanced in terms of our equity exposure. This is not a question of having one or the other, but finding that benefit of asset allocation is back, diversification is back. And when it comes to equities, you want to focus on a similar strategy in these types of bear market conditions. You want to focus on quality. Those companies with strong balance sheets, strong earnings, that consistent ability to grow their earnings and dividends, even in the face of some of these inflationary and growth pressures.
Gotcha. Kristen, good to catch up with you. Kristen Bitterly is Citi Global Wealth Head of North American Investment. Have a great weekend, Kristen.
You too.
Thanks.